Hello friends, my name is Abhishek Mishra. Today we are going to talk about second chapter of Mutual Fund Distributor Certification Examination. This particular chapter is about concept and role of a mutual funds. This we will cover part one of this particular chapter where we will talk about concepts, and in the next video we'll talk about mock test. Let's move on the very first slide. Let's talk about basics of mutual funds. So mutual funds is a way to mobilize money from investors to invest into different securities, different sort of market for the given stated investment objective. For example, there could be a number of investors in the market who are looking to park their money for short term for liquidity purpose. So mutual fund can create a particular fund or a scheme named as a liquid fund, and and it can choose multiple securities, money market securities, with less than 90 days maturity period, and that money from various investor is invested into those securities, and the objective of that scheme is aligned with the objective of investor, that is parking the money for short term period. Next is the primary role of mutual fund is to either generate an income or build their wealth. Either they are passing some income every month or every quarterly or yearly based, or they are just increasing their wealth. So to accommodate different type of preference of customers, as I said, liquidity is one of the criteria. There could be like someone who wants to plan for their retirement, someone may wants to create money for down payment of their house, someone want to just create their wealth for future generations. So based on different objectives, based on different preferences of customer, multiple type of funds are created. We call such multiple type of fund as a mutual fund scheme or mutual fund itself. Okay. The investment policy of a particular mutual fund scheme includes two main points. One is the asset allocation. That means how much money will be invested into different asset classes. For example, how much money will be in equity, in bond, in gold, commodities, or real estate, etc. And an investment style, it could be a passive investment style, it could be active investment style, or there could be a growth investment style, or value investment style. So the investment policy includes these two main important points. There are a few concepts. Let's talk about units. Is in mutual funds is nothing but is like when you are buying shares in the equity market, you buy 10 shares of a particular company. So that 10 shares, which in equity terms we call it number of shares, but when we do the same thing for mutual funds, we call it unit. Next is net asset value. So net asset value is what is the worth of one particular unit of that particular mutual fund scheme. It is called NAV. In short form we call it NAV, and it's a net asset value. So net asset value could be different for different schemes and for different AMCs because of the sort of investment they have done, at the timing of investment, or how long they have been into the market. Third comes asset under management. So a particular fund scheme can cater the needs of hundred thousands or maybe lakhs of crores of investors. So that money which has been pooled by investor to put in a particular fund scheme is called as a asset under management. So this asset under management, it keeps on going up and down every day's basis because of change in the NAV. How it happens? So let's say on the very first day when NFO got closed, some 10,000 crore in a scheme came. Now every of those investors have been assigned a unit. The initial units are 10 rupees, and apart from few expenses, at that price the units are assigned. So what will happen? That money, 10,000 crore, will be invested based on the asset allocation. The money value of that 10,000 rupees, because of investing into different places, could go up and down. Let's assume in a month's time it has gone 2% up. So 2% of 10,000 is like 200 crores. So the asset under management will be 10,200 crore. So this AUM is not fixed, it keeps on changing depending upon the changing NAV value. Let's talk about some of the advantages and limitation of mutual funds. Advantages of mutual funds is that investors professional management. So whatever money is there, that investment is professionally managed. There are fund managers who knows where to invest, how to invest, and it is done professionally and with a lot of transparency. That's the advantage of mutual funds. Second is affordable portfolio diversification. For example, if you want to do a portfolio diversification and you want to buy, let's say it's a equity based portfolio you want, so you have to buy probably 25 or 30 stocks. So buying each of those companies stocks may need you, maybe lakhs of rupees or maybe more than that to invest. But if you have some 5,000 to invest and you want to benefit from the portfolio diversification, you can put into a mutual fund scheme. Next come economies of scale, because individually money is not managed. All the investor pool their money and then fund manager manages that money. So in terms of cost and other things which may cost to a particular person while managing the portfolio, because of the economies of scale, the cost becomes low. Next come transparency. So a lot of rules have been formed by SEBI and the other regulators. So because of that, there is a lot of transparency in mutual funds. It's a highly regulated market. Next is liquidity. So all the open-ended funds are basically open to buy and sell at any given point of time, unless there is a very serious liquidity crunch issue in the market itself. So liquidity is one of the key advantage of mutual funds. You can put money today and few days later or few months or few years down the line, you can take it out any point of time. Tax deferral and tax benefit. So tax deferral means unless you sell your mutual fund units, whatever money you have earned in that mutual fund scheme, you won't have to pay taxes. You will only pay taxes when you have realized those profits. Now comes tax benefit. So some of the mutual funds investment, for example equity linked savings scheme, you can claim 1.5 lakhs at this moment. Until this moment, it may change in future under income tax section 80C. Next are convenient options. So you can invest through lump sum mode, SIP mode, or there are multiple other options through which you can invest. You can transfer from one fund to another fund through systematic transfer plan or through switches. So it is very conveniently managed sort of investment avenue. There are a few limitations of the mutual funds. Lack of portfolio customization. So a fund manager cannot customize a portfolio based on a given particular investor. The fund manager has to follow what is their investment objective. Based on that investment objective, the customization of the fund itself applies to everybody. It cannot be on individual basis or group of people basis. Choice overload causing confusions. There are 48-50 AMCs in India at this moment, and there are thousands of choices. So it creates a lot of confusion which one to choose or which one to not. No control over cost. Though there are regulations that a certain percentage of total return or total cost cannot be breached, but still within that limit also there is a lot of fluctuation. So cost is sometimes is not our control. And no guaranteed return. Obviously all these mutual fund investments are linked to market, so guaranteed returns are not possible here. So these are some of the limitations of mutual funds. Let's talk about classification of mutual funds by structure of fund. Three types of fund. One is open-ended, closed-ended, interval. So open-ended is like you come and invest today, exit any point of time. Closed-ended is that you have a fixed maturity after 3 year, 5 year, 10 years, 7 years. You can buy only during the NFO. But if you want to exit out of it, you cannot do that by selling it to fund. You have to find a buyer on the stock exchange, because closed-ended funds are always listed on a stock exchange. When you are going to sell there, you have to find a buyer. If there is no buyer available, you might not able to sell it. So that's a challenge also with the closed-ended fund. Then interval funds. These are largely closed-ended funds, but they sometimes get open for a specific period, for let's say 7 days or 10 days, minimum 2 days to 15 days. That's when they are open and person can exit out of it and can get an entry into it. Next is minimum duration of interval funds transaction period is 2 days and maximum is 15 days. Both of closed-ended and interval funds are listed on the exchange, but liquidity could be a concern because not all the time these funds can be liquidated because there are no buyers in the market. Next come exchange traded funds. ETFs are basically nothing but these are they addresses this liquidity issue. So what are ETFs? ETFs are those mutual fund schemes that are traded on a stock exchange. So basically what happens generally, what ETFs are created, they track an index. So they are mostly passive in nature. So there could be different prices on a given day because one investor want to exit very he has a need, so he can discount the price. But one person, he just may not be in that much need, he would like to keep it as same as price, same as NAV. And remember, to buy and sell ETF, one must have to have a demat account. It cannot be through physically. Next come classification of mutual funds by the management of the portfolio. So one is actively managed fund, second is passive funds. So actively managed funds where the fund manager has the flexibility to choose the investment portfolio, and whenever he want to buy or sell a particular security, he can do on his own mind, but all the buying and selling should be as per the investment objective of the scheme. And the idea here is to perform better than the market index, and because there is a frequent buying and selling, the expenses of running such funds could be higher. Next come passive funds. So passive funds are generally where they follow a particular index. These are also called as index fund. So index fund is nothing but what happens, you take a particular index, for example Nifty 50. Nifty 50 is nothing but a basket of top 50 securities of Nifty NSE. So a particular Nifty 50 based index fund will track how Nifty 50 itself is moving. Its idea or its objective is to generate the same return as the Nifty 50 is generating. So they are not generally designed to perform market better than the market, but these days it is expected that such fund should perform, overperform, or outperform the market index. And any deviation in the return of index fund in comparison to the index is called tracking error. So for example, Nifty 50 has given a return of 2% in a month, but index fund itself, which is tracking this particular Nifty 50, is given only 1%. So that means there is a tracking error of 1%. But if let's say even fund has given more than 2%, whatever is that difference is, that will also called as a tracking error. The lower is the tracking error, the better is fund considered, and these are the very low cost products, low cost funds. So let's talk about mutual fund scheme categorization. So there are 5 categories I have mentioned: equity, debt, hybrid, solution, other schemes, and there are various subcategories. And then within the equity space, there are 3 caps, or you can call it large cap, mid cap, and small cap. So first 100th company in terms of full market capitalization, they are called as large cap company. Mid cap are those which lies between 101st to 250th company in the full market capitalization, and any company beyond 251st company onwards in a full market capitalization, they are small cap companies. Let's move to the equity schemes. So multi-cap, what is multi-cap? They can invest into various caps like large cap, mid cap, small cap. What should be their minimum investment in these 3 sort of large, mid cap, and small cap is minimum 25, 25, 25. Then the remaining 25% could be put into one. Maybe large cap can have a 50%, rest to other 25, or mid cap can have a 50%, the other 2 can have a 25. But the basic idea is that minimum 25 each of these large cap, mid cap, small cap should be there in the multi cap. What is the large cap fund? When the minimum investment in the large cap stocks is done by 80% of the fund. So let's say fund has a 100 crore AUM, so 80% of it, which is 80 crore, has to be invested into large cap fund. Next up, large and mid cap. So this is a combination of large cap and mid cap, where minimum investment in large cap and mid cap should be 35% each. Then you can increase in one into like 70% as well. Sorry, 65 as well, because the minimum criteria as specified by SEBI is that 30%, 35% you have to invest into large cap and 35% into mid cap. Then comes mid cap. Minimum investment in the mid cap equity should be 65%. And the same applies for small cap. If you want to create a small cap fund, 65% of the money of that fund should go into the small cap. Next comes dividend yield fund. So this should be predominantly investing into dividend paying stocks, and the minimum investment in such stock should be 65% of the total fund value. Then comes value fund. Value fund is nothing but they are following a value investment strategy, where what happens today, the price of a particular set of security is not realized by the market, so it is trading at a very low price. But tomorrow when the market realizes its benefit or its value, the price will shoot up. So such strategy is called value fund. Then comes contra fund. Contra fund is nothing but when there is a contrarian investment approach. The minimum investment in such equity type of stock should be 65%. Coming to focused. So focused fund can have a maximum 30 stocks. Scheme should mention where they are going to invest, what sort of focus they have, and minimum investment in equity should be 65%. Then comes sectoral or thematic fund, investing into a specific sector such as a bank, pharma, infrastructure, financial services. So such funds are called sectoral fund. And thematic could be a broader term of sectoral. For example, banking sector is a sectoral fund, but financial services could be a thematic, which can include not only bank but also insurance, asset management companies, etc. Okay. Next is a equity linked savings scheme. We call it out ELSS, and sometimes we also call it as tax saver funds. So they have a 3-year lock-in period, and they offer tax benefit where the minimum investment of equity shall be 80% as per the ELSS scheme 2005 notified by Ministry of Finance. So most of the for example, minimum and maximum investment into asset classes or various type of sector is defined by SEBI. But in case of ELSS, remember, this has been decided by a notification by Ministry of Finance, which is named as a ELSS scheme 2005. Next comes flexi cap. Flexi cap is nothing but a fund manager has a flexibility to invest across large cap, mid cap, and small cap. So there is no sort of that you have to have a 25% in each of these three: large cap, mid cap, and small cap. We don't have such criteria here as there were in multi cap. Flexi cap gives the flexibility to fund manager. Okay, but the total money of total funds 65% should be invested into flexi cap. Should be invested into equity. Sorry. Next come debt scheme. So these are 7 types of debt scheme on this particular slide. There are more. Let's talk about it. Overnight fund, where the investment is done into those securities, where we call them overnight securities, where the maturity is of 1 day. These are the most liquid type of fund. The second is liquid fund. So the investment is into debt and money market, where the maturity of the securities is 91 days only, maximum 91 days only. These are one of the safer funds within the debt category after overnight fund. Ultra short duration fund. Here the duration of debenture security whose duration is between 3 months and 6 months. Next come low duration fund, where the duration of all the combined securities of the portfolio should be between 6 months and 12 months. Next come money market fund. Money market fund where the money is invested into money market securities where maturity is up to maximum 1 year, not beyond that. Next comes short duration fund. Short duration fund is nothing but where the duration of the portfolio is between 1 year and 3 years. So when we say duration of the portfolio means that majority or most or maybe all of the securities between in those portfolio, they will get matured between 1 year to 3 year. Then comes medium duration bonds. These invest into debt and money market instrument with Macaulay duration of portfolio between 3 years to 4 years. So Macaulay duration is nothing but it is a formula which is used for figuring out what is the overall duration or maturity duration of a combined set of securities. Then comes medium to long time. So the difference only here is the maturity. So medium to long duration, that means 3 years to 4 years duration should be of portfolio should be there. Then come long duration fund. Basically, long duration funds are those where the duration is of all the securities invested is more than 7 years. So for example, today's world, let's take an example how long duration funds matter. So today, let's say interest rates of a 10-year government bond is 7%. Okay, now if you want to invest into if you see that this 7% will go down in coming years as the economy matures or as we progress, so it's always too good to invest into long duration because you're locking 7% government bond interest rate. And it can be otherwise when you think that the 7% in future 1 year 6 months down the line could be 8%, it's better to invest into short duration funds. Next come dynamic bond fund. Dynamic debt scheme that invest across multiple duration, various duration. It could be short, medium as well as long duration. Banking and PSU fund. So these are the debt funds which are investing debt instruments of banks, PSUs, public financial institutions and municipal bond. But the criteria is that minimum investment of such fund should be 80% in such securities of the 80% of the total securities, total assets, sorry. Corporate bond fund. Corporate bonds are one of the safest fund on the because they are they are investing into AA plus and plus rated corporate bond corporate bonds are there. The minimum investment in corporate bond shall be 80% of total assets. Okay, it cannot be less than that. Then credit risk funds are nothing but a reverse of what is corporate bond. So corporate bond fund invest into highly rated bonds. Credit risk fund invest into low rated bonds where there is a extra interest or sort of income a fund manager can generate. So definition and the other differentiation is that minimum investment in such corporate bond shall be 65% of the total asset where rating should be AA and below. Next come gilt fund. Gilt fund is, remember GSEC, gilt, they are meant for government securities. So they are investing into government securities across various maturity period. So minimum investment in GSEC should be 80% of the total asset. Then comes gilt fund with a 10-year constant duration fund. So basically these are investing into government securities having a constant maturity of 10 years. Next comes floater fund. Floater funds are those that are investing into floating rate instrument. Here the rate of instrument is tied up to something else and it keeps on changing every other month or week or maybe daily or quarterly, whatever is that type of instrument is. And the minimum investment should be 65% of the total assets. Next come hybrid scheme. Hybrid scheme's name itself says that it is a combination of equity and bond. So conservative hybrid fund is where you are investing more into the debt size. Okay, so debt instrument investment should be 75% to 90%, and the equity will be whatever is the remaining. Then comes balanced hybrid fund. So that means balanced should be like debt should be, or equity should be, somewhere between 40 to 60. So if you see 50% equity, 50% bond, or 40% equity, 60% bond, or vice versa. But the minimum investment in debt instrument in balanced hybrid fund should be between 40 to 60, and remaining could be in equity. Next comes aggressive hybrid fund. So aggressive hybrid fund says that investment into equity should be 65% to 80% of the total asset, and the remaining can be into the debt instrument. And the fourth one comes, which is dynamic asset allocation or the balance advantage. Here the investment in equity and debt is managed dynamically. It's a call on the fund manager to see, based on the market condition, where he or she has to allocate the asset into equity or bond. When equity market is doing well and overpriced, then fund manager can shift it to bond, and reverse can happen when there is a downfall in equity market. So fund manager can bring the money from debt side and to move it into equity market. So it's a dynamically managed sort of asset allocation. It's absolutely on the fund manager. Next come multi-asset allocation. So multi-asset allocation is where there are, so the difference between hybrid and this is also type of hybrid actually. So the three main hybrid funds are there. They are different to multi-asset allocation in a form that here we have at least three asset classes, and minimum investment in these three could be 10%. Okay, and foreign securities are not treated as a separate class in this kind of scheme. We have to remember that. So if let's say equity, bond and gold, these are the three asset allocation of a multi-asset allocation fund. So 10% should be in each of them, then remaining 70% you can deploy any of those three classes. Then comes or arbitrage fund. This is where investment is done to find out arbitrage opportunities. The minimum investment should be 65%. Arbitrage opportunities are those where, let's say, the price of a particular security in NSE or BSE is different at the same time. So you buy at a lower price and sell it at the higher price in the other market is called arbitraging. Next comes equity savings funds. So equity savings funds are nothing but combination of equity, arbitrage and debt. The minimum investment in equity should be 65%. The minimum investment in the bond should be 10%, or the minimum hedged and unhedged should be stated in the SID. Next comes solution oriented schemes. So these are two solutions, retirement fund or children's fund. So these are both of them have a different objective. The underlying principle is same, that they have to be in lock-in period for 5 years, or when the retirement age is coming in case of retirement, or in case of children funds when the child attains the age of majority. Okay, and these could be retirement funds or children fund, could be equity based, debt based or hybrid based funds, and they are meant for long-term planning purpose. Maybe in the retirement case it's for retirement corpus, and for children fund it may be to create a fund for needs of the child in coming years. There are other type of funds, for example index fund or exchange traded funds. So these are open-ended schemes. Basically they are replicating a particular index we already talked about. And the index fund should be, the composition of index fund should be, or the securities of index fund should be those of same as the index it is following. 95% of the securities should be same as index itself. Then comes funds of fund. Funds of fund is where it's sort of name itself says that a fund is investing into another fund, and it can be overseas as well as domestic. The minimum investment in an underlying fund shall be 95% of the total. It cannot be less than that. And there is another fixed maturity plan. So fixed maturity plans are nothing but they are type of closed-ended debt fund. The duration of such investment portfolio is closely aligned to the maturity of scheme. So for example, you have a 365 days fixed maturity plan. So fund manager will invest into those securities where the duration of those securities matches with the maturity of the fixed maturity plan itself. So it's more of, the purpose of such a fixed maturity plan is to have a more predictable returns, though returns are not assured. That's all for this particular chapter. These are the concepts which are available in this particular chapter, and in next video I'll bring the mock test related to this particular chapter. So once you have done this conceptual clarity part, you can move to the third video, and I'm sure once you go through them, you'll have a great clarity in terms of your concepts, as well as answering in your exam. That's all for today. Thank you very much. Bye bye.